Greetings, family. This is your brother in the kingdom, Emmanuel Destiny. Welcome to yet another valuable episode. And of course, we're just going to be 10 minutes on your screens for this Forex beginner series. And of course, we're talking about when to buy or sell currency pairs. And of course, this is just information and theory that we're going into because we're still in a beginner series, so we're still laying in the foundation. By the time we get into intermediate, then you're gonna see us now practicalizing everything. So I need you guys to understand exactly what you're watching now, and especially if you're a beginner, please kindly subscribe, like, and share this video with your friends and family. Now we just want to go straight into the information and do not waste any time, of course, introducing this. When to buy or sell currency pairs. Now in Forex trading, in Forex, it involves a lot of trying to predict which currency is going to rise and fall versus the other currency. And of course, how do you know exactly when to buy or sell a currency pair? Now we're going to take it from the real foundation, then, and of course, we're going to build up on that concept. And in the following examples, I'm going to be using a little bit of fundamental analysis to help us decide where do we actually buy or sell a specific currency pair, or rather even an asset. And of course, the supply and demand for a currency pair changes due to the various economic factors which drives the currency's exchange rate up and down. And of course, each currency belongs to a country or a region. So Forex fundamental analysis focuses on the overall state of the country's economy, such as the productivity, employment, manufacturing, international trade, and interest rates. Now we want to go to the next point, and of course we just want to make you understand what do we mean before we can actually get to the practicalization of the information that's been taught here. The foundation must be strong first before we can start going all the way up. Now I'm going to start with Euro USD as an example, then I'll go to a bit of at least 3 examples in order to land and establish this example as a foundation. Now of course, in this example, Euro being the base currency, and of course that's on the basis of us buying or selling. So what I'm essentially saying there is that the base currency is what you decide as you're trading a currency pair to say, am I buying this, or am I saying this, or am I selling this due to the nature of the base currency? Okay, so it should be the basis of why you're buying and selling. So for example, if you believe that the US economy will continue to weaken, which is bad for the US dollar, you will execute a buy for the Euro USD. Why do I say that? Because this one is weakening and this one is, of course, increasing in strength. Therefore, you're anticipating an appreciation of value for the euro against the dollar, hence it's weakening. By doing this, you would have bought euros with the expectation that it will rise versus the US dollars. And of course, vice versa now. If you believe that the US economy is strong and the euro will weaken against the US dollar, you will execute a sell for the Euro USD. By doing this, you have sold euros with an expectation that it will fall versus to the US dollar. Of course, I want to also come up with another example here. Let us get into it even much deeper now. Okay, so USD JPY, and of course the US dollar there is our base currency, and it will be the basis of how we buy and sell. Again, if you think that the Japanese government is going to weaken the yen in order to help its export industry, you would execute a buy for the USD yen. Okay, by doing this, you have bought USD dollars with the expectation that it will rise versus the Japanese yen. If you believe that the Japanese investors are pulling money out of the US financial market and converting all of the US dollars back to yen, this would hurt the US dollar, and you would execute you would execute a sell for the US yen, or rather for the USD JPY. By doing this, you have sold US dollars with the expectation that it will depreciate against the Japanese yen. Now let's learn another example, guys. GDP USD, this is the last example, then we lay down the concept. This example, the pound, of course, it's the base pair, and of course, hence is the basis of why we want to buy and sell. If you think that the British economy will do much better than the US economy in terms of economic growth, then you would execute the buy on GDP USD. By doing this, you've bought pounds with the expectation that it will rise in value versus the US dollar. And of course, if you believe that the British economy is slowing while the American economy remains strong, then you will execute the sell on GDP USD. By doing this, you've sold the pounds with the expectation that it will depreciate in value against the US dollar. And I just hope that you spot the pattern that we're talking about. If there's a strong economic country, and of course that results into the currency being strong, and hence is strong compared to the other, then that results into us buying it if it's the base currency, and of course if it's the code currency, then that it will result in us selling it. I hope you now get exactly when to buy, and of course we'll go deeper into fundamentals on the next other episode, because that's the real foundation, the cream de la cream of trading, is to understand exactly what influences the market in order to buy or sell in order to make a sound decision. Yes, we're going to go through technical analysis, but combining the two is going to give us a very powerful method of approaching the markets. Now, as we're talking about buying and when to sell, we need to understand how are we buying these things. And for example, that I'm going to use, when you go to the grocery store and you want to buy an egg, you can't just buy a single egg. They come in dozens or lots of 12. In Forex trading, it will be the very same thing, right? It will be just as foolish to buy one or sell €1. So you usually buy it in lots, or they come in lots. In fact, you don't have any choice. So you come in lots of 1,000 units, that's micro there. And of course, 10,000 units, that's mini. And of course, we have 100 units, that's standard, depending on your broker, the type of account you have, and more lots later. Okay, that will actually zero in there. So of course, that's now talking about lot sizes, and they control the amount of risk that you're willing to take as a trader. Okay, and now of course, as hence we've dwelled in, and of course we're gonna dwell more into it in other episodes. I'm just touching in order for you to understand exactly what we're talking about here. Now we have margin trading. For example, you would say, I don't have much money or enough money to buy 10,000 euros. Can I still trade? Yes, you can, by using what we call leverage. So margin and leverage, they're brother and sister. What do we mean by this? When you trade with margin, you wouldn't need to pay 1,000 or 10,000 euros up front. Instead, you will put down a small deposit, and that small deposit is known as margin. For example, now, leverage is the ratio of the transaction size or position size to the actual cash trading capital used for margin. For example, now, let's say your leverage, it is 1:50, right? Or whichever way you want to say it, 50:1. And of course, if we put it in terminologies or percentages, that can be known as 2% margin requirement. Means that 2,000 US dollars of margin is required to open a position worth 10,000 or rather 100,000 US dollars. So now when we talk about margin trading, let's say you open a large position using only a fraction of the capital that you normally need. So this means that you'll be able to open, let's say, 1,250 or 50,000 US dollars worth of position with as little as 25, even all the way to 1,000 US dollars. So what do we mean by this? You can conduct a large transactions with a small capital of your initial deposit. Okay, so of course, when to buy and when to sell comes with that, but we're gonna zero in a lot when we talk about margin trading later into the episodes. That's another reason for you to actually subscribe to our channel, because more valuable content information comes up by bits and bits that you're able to digest exactly what we're saying to you. So let me explain something here. When we're discussing margin trading in more of the later episodes that we'll have, but we want to actually dwell into something here. Let's say you believe that the signals in the market are indicating that the British pound will go up against the US dollar, and you open with one standard lot. Okay, that means 100 units of GDP USD. Buying the British pound with 2%, that is 1:50 leverage, if we can put it like that, you will wait for the exchange rate to climb, so increase in value. And when you buy with one lot, 100 units of GDP USD, let's say at the price of 1.500, and you're buying with 100 pounds, which is worth 150 US dollars. That means that the 100 units of GDP USD are actually times by the price or the exchange rate. And since the margin requirement is only 2%, 1:50 then, that means that we're actually taking 3,000 US dollars. That is leverage for you to trade. So you may have a small amount. So that means they're actually empowering you with 3,000 in able to be open or to open that trade of 100 units. Then you can control, and of course now you will have at least could have made 500 either from your 100 pounds or whatsoever the capital may have been. So we're essentially now showing you the power of margin and leverage as you're buying and selling. But why did we actually start now? Let's just go back. Why did we actually start with making you understand when to buy? What influences you to make a decision to buy? Then understanding when you're buying with, what are you buying with? Are you buying with one lot, standard, mini, or micro? Then you can actually get to understand the risk involved in that, and then you can make a sound and rational decision to actually trade and execute the position. So that's why we're actually talking about this information. And of course, we have what we call a rollover. Some of you know it as the swap fee or as the rollover fee. So because we have different types of trading, like your swing trading and your intraday trading, for example, positions, or rather for positions open at your broker's cut-off time. So in our South African time, that's like midnight, okay? GMT +2. I'm sure it's like 5 ET, if I'm not mistaken. And of course, that will be 11 GMT +1, that's UK time there. There is daily a rollover fee, or also what we call a swap fee, that the trader either pays or earns. Most of the time, we actually pay that through what we call, when you close your trade, or when you've closed your trade, they will take that fee by themselves. Many brokers do that. So if you do not want to earn or pay interest, you simply can make sure that you close your trades before 5 p.m. ET or GMT +2 midnight, or of course 11 p.m. GMT +2, which is UK time. Okay, so you can either now, before you execute your trade, know exactly what style of trading you are, even though I'm going to zero in more into this subject a bit later. Are you a swing trader? Are you an intraday or even a scalper trader? Know exactly why you're buying, how long you're buying it, with how much you're buying, or rather selling. Okay, and of course, since every currency involves borrowing one currency to buy another, interest rollover charges are part of forex trading. And of course, when we're talking about interest rate, they're either paid on the currency that is borrowed, or rather earned on the currency that's bought. We're gonna zero in more of that, but I just hope that you understand now what we're talking about, when to buy and when to sell currency pairs. What is the influence or the confluence that you should get? The more we get into the practicalization of this, what I've said right now, it's going to be as a foundation that when we start to build on technical and fundamental, it's going to be as easy as you just matching those puzzles together and understanding it quite well. Anyway, I just hope that you've enjoyed this episode. Guys, make sure to subscribe, like, and switch on that notification bell, and refer this channel to your friends and family out there, because we're going all the way up. We are the best growing channel, educational channel in SA. Make sure that we can get your support as we grow. Okay, so see you on the next episode, guys. Your brother in the kingdom signing out.